Singapore Treasury bills or T-bills have been super popular recently. Just last month, the T-bill yield hit an all-time high of 4.19%, the highest since 1988. Sibei high sia. And as usual, Singaporeans be like, all-time high? Chiong ah! Everyone rushed to get the next T-bill. As a result, it was massively oversubscribed. Non-competitive applications were only allotted 49% of the investment amount, and there was a delay in publication of the auction results. Bo. So, in this video, I will share everything you need to know about Singapore T-bill. What is it? How does it work? What do all these weird numbers mean? And more importantly, what's the best strategy to make sure you get the best possible yield? As usual, before I start, I would greatly appreciate it if you can help to tap the like button and subscribe if you haven't done so. In return, I will show you a cute cat. Alright, let's start right now. Okay, I'm sure most of you already know what T-bills are. But just in case there are people who are still blur and be like, what is T-bill? Can it one nah? Let me quickly explain what it is. Basically, T-bills are short-term government bonds that mature in 6 months or 1 year. It's a good investment for people who want to park their cash somewhere and earn some interest in the short term. Yes, I know that the 4% yield may sound little, but that 4% yield is currently outperforming almost everything this year, including your Tesla, Google, Bitcoin, and even Warren Buffett Gong Gong himself. However, the biggest downside of T-bill is that unlike SSB, you can't redeem it early. The only way to get back your money is by selling the T-bill on the open market. And the problem with that is there's almost no trading volume on that, which leads to very wide bid-ask spread. So if you were to sell the T-bills on the open market, you will confirm plus chop get lowball like what usually happens in carousel. The way T-bill works is a bit different from normal bonds. For normal bonds, they will pay you a fixed interest every year, right? But for T-bills, they won't pay you any interest. Instead, they will just discount the interest of your initial amount. For example, for the latest T-bill, the cut-off yield is at 4%. And because it's a 6-month bond, you will just get a 2% yield for that 6 months, right? Then, when you invest $100, they will discount $2 interest of it. So that's why the cut-off price is at $98. Then after 6 months, they will return $100 back to you. So that's a simple explanation of what T-bill is. Quick pause, we are now in November, and you know what that means? Even more sign-up bonus from Weibo. Weibo has further increased their sign-up bonus to $150 cash voucher. All you need to do is deposit at least 2,000 SGD into Weibo, buy a US stock or an US ETF with a minimum transaction of at least $100. Then buy one option on the US market while maintaining a 2,000 SGD net account value for that 30 days, and you will receive all your free rewards. So if you are interested, you can sign up with my link down below. With that being said, let's get back to the video. Now, as mentioned earlier, the reason why the last T-bill is super oversubscribed was because the yield is super attractive now. But I have a better explanation as to why it's so oversubscribed now. My theory is that there are a lot of people using their CPF OA money to invest in the latest T-bill. That's because previously, T-bill yields have always been below 1%, so nobody bothered with them. But since the start of this year, due to US interest rates going up fast and furious, T-bill yields have also been going up to the moon. With T-bills giving 4% now, obviously it's a good idea to invest our CPF OA money into it to earn a higher interest, right? Check this out. As of last quarter, there was $17 billion worth of CPF OA money in the CPF investment scheme. That explains where the additional $4 billion application money came from. And that's just the money in CPF IS, yeah? There's still $179 billion sitting in CPF OA money that's not being used yet. So that's why as long as the T-bill yield continues to be around 4% or more, more people would be investing their CPF OA money into it to earn a higher interest. But here's something very curious. Why did the yield drop from 4.19% down to 4%? Okay, to answer that, let's first understand how the whole allocation process works. When bidding for T-bills, you can choose to do a non-competitive bid or a competitive bid. So think of it like buying shares, where you can choose between limit order or market order. Non-competitive bid is basically market order, and competitive bid is limit order. Okay, let me explain. For non-competitive bids, you will just get whatever is the cut-off yield. For the last auction, the cut-off yield is at 4%. So everyone will just get a 4% yield. However, just take note, if the non-competitive bid exceeds 40%, like this round, the bond will be allocated on a prorated basis. For example, here you can see that 40% of $4.5 billion or $1.8 billion is allocated to non-competitive bids. And because it's prorated basis, non-competitive bids could only get 50% of the amount. So if you bid for 10K, you will only get 5K worth of T-bills. So that's non-competitive bid. For competitive bid, I will just use the explanation from Red Devil 0728 from Hardware Zone, because he explained it very well. If your bid is lower than the cut-off yield, you will get the full allocation. If your bid is at the cut-off yield, your allocation will be prorated. And if your bid is higher than the cut-off yield, too bad, you won't get anything. Or to put it simply, the lower your bid, the higher your priority of allocation. Let's use an example. Let's say there's $10 of T-bills being offered. Each T-bill is worth $1. Retailer A applied for a $4 non-competitive bid. Retailer B applied for $3 competitive bid at 0.01%. Basically, he's a low baller. Institutional investor A applied for $2 competitive bid at 2%. B applied $3 at 2.1%. C applied $5 at 2.3%, and D $1 at 2.6%. Remember that non-competitive bid could only get allocated up to 40% of the offered amount. So retailer A gets allocated $4. Then, because lower bids will get prioritized first, retailer A gets the full amount at $5. Institutional investor A gets the remaining $1, because remember, there's only $10 worth of T-bills here. And since it gets cut off at 2%, 2% is now the cut-off yield. So that's the simple explanation of the allocation process. One more thing, because everyone bids for a different yield, you will get a bell curve like this. You have the mean yield or the average yield, and you have the median yield, the center point of the curve. That's what this median yield and the average yield is all about. Anyway, if you totally catch no balls what I just said, just remember this: the lower your bid, the higher your priority of allocation. Now, I'm sure you will immediately be like, obviously the best strategy is to set a 0.1% competitive bid, right? That way, I will get allocated everything while getting the best possible yield. And that's exactly what many people did this round. If you check the average yield for this round, it's at 2.87%. Then for the previous two yields, it's above 3%. That's because there were many low ballers for this round, and that pushed the average down to 2.87% and the cutoff yield down to 4%. Without these low ballers, the yields would have been much higher. However, even though low balling is a valid strategy here, if you are investing your CPF OA money, you need to be super careful because of how CPF calculates its interest. They will always use the lowest balance for the month to calculate the interest. For the latest bond, you invest the money in November, and the money is only refunded back to your CPFIS in May after the bond matures. After that, you can either keep it in CPFIS or transfer it back to CPF OA for it to earn interest. So from November all the way to May, the money won't be in CPF OA for 7 months, right? So for this bond, the break-even yield needs to be at least 2.92%. Otherwise, it won't be worth it. Or take another bond for example. It starts from October and ends in May. That is 8 months. For this bond to be worth it, the break-even yield needs to be at least 3.33%. So the moral of the story is, don't just blah and anyhow lowball ya. If you are planning to invest your CPF OA into T-bills, you need to use competitive bid to avoid earning a lower interest than CPF OA. Bid for at least 2.92% if the bond spans across 7 months, and bid for at least 3.33% if it spans across 8 months. Otherwise, you will be getting a lower interest than CPF OA. Or another strategy is submit multiple competitive bids. That's because they allow multiple submissions. So let's say if you want to invest 10k, what you can do is bid for 2k at 3.8%, 2k at 3.9%, 2k at 4%, and so on. That way, you will make sure at least some of your bids are allocated, and at the same time, not lowballing too much until it pulls the average down. Now, even though investing in T-bills is super low risk, there's still risk involved, and that is opportunity cost. The federal funds rate is expected to peak in 2023, and that can cause two things to happen. One, T-bill yields might start falling, and two, the stocks might start going back up. I'm not saying it will. What this means is, by the time your 6 months T-bill matures, you might miss the market rally, and you might get a lower T-bill yield the next time you subscribe. So that's the risk of investing in 6 months T-bill. My suggestion is only invest the money that you are not planning to invest in the stock market in the next 6 months, because you don't want to miss the market rally. Instead, you can invest the money that you need in the short term, like renovation money that you need 1 year later, or wedding money that you need 2 years later. And don't just aim for the 6 months T-bill. There's also the longer term SGS bond that comes out every month, or the 1 year T-bill that comes out every quarter, where you can lock in a high interest rate for a longer period. Anyway, that was a quick explanation on how T-bills work. If you want to invest your cash into T-bills, you can check out this video where I show you a quick step-by-step guide on how to invest in T-bills using cash. Or if you want to invest using CPF OA, you will need to head down to your bank branch to apply. Anyway, that's all for this video. Hopefully, it helps you out. Like, share, and subscribe, as I'll be posting new videos every Monday, Wednesday, and Friday.